All right. Welcome back to the channel, everyone, and thank you for tuning in to another great video. I know it's been a few days since I uploaded and posted a video, but today is Sunday, August the 20th, and I wanted to show in this video here how you can actually trail behind the market in a sense once you're into a position or trade to kind of keep yourself in the trade. You know, I'm not saying that the market won't pull back and may stop you out, but it will lock in profit as price is moving, let's say, in your direction. So as price is moving, you're able to adjust your stop loss in a sense, okay, for those that trade with a hard stop, okay. And I'm going to show you, one or two examples and using the 4-range chart paired with the 12-range chart. So basically, if we have a setup at a supply or demand zone, and then we're scaling down to a 4-range to get us more into a precise entry. Primarily most traders, look for maybe a W or M structure formation. But as I've shown in the past, what I look for when I scale down is basically a break of structure in the opposite direction, or just kind of fine tune my point of entry once price taps into an either a supply or demand zone off of, say for instance, I'm using my 12-range chart as my higher time frame to mark my zone, and then I scale down to my 4-range chart to actually use as my entry chart. Then what I like to do is go ahead and mark off that zone and look for a break of structure off the lower time frame. So let's talk about that. I'm going to show you just a little technique that you can use so that once you're into the trade and the market starts moving in your direction, what to kind of look for and what to do next. So let's talk about that right now. So what I like to do is start off by using the 60 range chart, okay? Just to kind of focus, we're talking about time frame around August the 11th, because that's actually the last day that I actually took my last trade prior to taking a little downtime, okay? So each one of these areas you see here, these marked off rectangular areas, were primarily focuses of interest for me. So zones that I was looking at and zones that I took some trades from. So looking at my highest time frame, or my higher time frame, I'm not gonna say my highest, but my higher time frame, the chart that I actually turned to on a daily to kind of depict or give me an overall directional bias within the market. If we go back to the 11th, say for instance, right? Okay, what we see the market doing is moving to the downside here, making higher highs and higher lows. All right, so around the 11th, we got a low here. I'm not gonna say a lower high, because we actually kind of retraced back higher and took out these highs right here. But basically, we did get a retracement, and then it pushed to the downside. So we made a new low here. So we got a high sitting right here and a new low sitting right here. Okay. So when price made this low, made this high, and then we have this low here, we're still moving in the direction to the downside. All right. Even if you were to take a, let's just say a, which I don't use primarily too much, a trend channel, and just kind of marked it off, you can see that we're still moving in the direction to the downside, of course. All right. So my bias would be still, looking for opportunities on August 11th to do what? To take short entries, okay? So now I'm going to scale down to my 12-range chart and start looking for opportunities to take shorts, right? At supply zones. We're looking to go short. We're looking for areas to, at supply to, excuse me, guys, I think I'm going a little too far ahead, to go short, okay? Just kind of blowing this up a little bit so you can see. And we're going to take a look at this rectangular box here as an area of supply. Now, when I talk about supply, aggressive selling to the downside, I'm looking for what? I'm looking for opportunities. First of all, a break of structure. And then secondly, I'm looking for an area sitting or resting above a high volume area, okay? When we're talking about the volume profile, because I always talk about sell the highs and buy the lows, okay? We want to buy at discounted prices, and we want to sell at premium prices, or areas where there's premium, where the market is, where there's not higher highs, where the prices are higher, okay? So premium, sell, discounted areas, buy, okay? So this is a supply zone that I marked off now that I've identified the fact that we are bearish, okay? All right, that's the directional bias in which I'm thinking, and I'm looking at the market that we are moving to the downside, okay? So I marked the supply zone here off, okay? And as price retraces back to the zone, it's moving above a high volume area, okay? These are high volume nodes or peaks, okay? I like to call them peaks and valleys, okay? We have peaks here, valleys, peaks, valleys, peaks, valley. So the low nodes are the valleys, and the major areas will be our peaks or high volume nodes, okay? HVNs, LVNs, all right? So as prices retracing back to the zone here, I'm looking for an opportunity to go short, okay? Because we got a push to down. We got a low, a lower high, and then a push to the downside, breaking structure right here below 66, all right? So that's what I'm looking for. Now, this is a supply zone. Why? Because we got aggressive sell on to the downside. And when price retraces back to that zone, I'm looking for to see if there are any, primarily imbalances, because imbalances to me at a zone primarily ring what? High probability setup. Now, if we take a look what happened here coming out of this zone, price push down, pull back, push down. We got a pullback here, and it filled in any means of imbalance back here to the supply zone, correct? Okay, even within the supply zone. See, right here, okay? But we do have a fair value gap in between this candle here, the break of this candle that took out this candle here, and this next candle. So there is a fair value gap right here, all right? And I'm just going to show you, okay? We have a fair value gap back at the area of, or we're tracing back to the area of supply. These little blue arrows I'm marking are areas where there are gaps within the market, okay? Right here, this is the fair value gap. So as price retraces back to this zone right here, there's a fair value gap or a gap that gets filled there, okay? I'm not talking about the actual, is there an imbalance resting right at the zone? No, because it got filled as price was moving lower. As price retraced it back, it filled in any little imbalance or gap areas, okay? But there are fair value gaps that price still needs to fill in. So as price retraced back to the zone here, it filled in any means of fair value gaps, and that's okay for me. If there are fair value gaps as prices were tracing back to an actual zone there, okay, then to me, it still lies an opportunity in which price could actually reject, okay? So we got a fair value gap right here, price is pulling back to it, and as it taps into that zone right there, there's still, an interest or opportunity to actually go possibly short if we get rejection. Now, I'm scaling down to my lower time frame to look for that means of rejection. And the reason why I had interest in this trade was because we had a FVG or fair value gap on the pullback testing that supply zone again, okay, or testing that zone, okay? Because when price broke below the zone as it moved below here, okay, so we got a break below with the close of this red candle right here that broke below this green candle, right? The next candle actually on its move to the downside when it broke below, it pulls back and fills any means of imbalances or gaps to the downside. But as it continues breaking to the downside, again, it leaves behind those fair value gaps, all right? So there's still FEGs or gaps left within the market as price retraces back to the zone, all right? And when it comes back to fill that area of imbalance or that gapped area right there, then, to me, there still could be an opportunity to go short if there are means of rejections. But that's not what this video is all about, talking about, fair value gaps and imbalances resting back at the zone, those type of things. I've covered that in many videos. I just wanted to show you a way to trail, how you can trail behind price once you're into a trade, meaning moving your stop loss so that you don't get stopped out, or so you, well, I'm not gonna say that don't get stopped out. What I mean is to where you're protecting your profits, okay? Once you're into a profitable trade, a means of being able to capitalize on some means of profit, all right? So when price retraces back, taps in, fills in that FVG back to the supply zone here, we're going to scale down now to a lower time frame, which is my 4 range chart, to look for a setup, all right? Meaning rejection, to be able to go short, all right? Meaning going back to the downside. So when I look at this opportunity right here off the supply zone and resting back at this fair value gap, I see below here that there really probably not going to be much that's going to stop me back if I take a trade going short, my aim will be to take price back down to at least here around the 62 area, okay, to fill in some of these gaps back to the downside or imbalances back to the downside, okay, because we have untested areas of imbalances back to the downside. That means the area of price rush to the upside here with this aggressive buying. Back to the downside here will be an area where price probably will definitely want to fill some areas of imbalances. Yes, this is a demand zone resting down here at the bottom as well. So I would be looking to take a trade from the supply zone, fill in some imbalances back to the downside, back to this demand zone. Okay, so let's scale down now to the 12 range, excuse me, to the 4 range chart and look for that means of rejection off the 4 range. Okay, now I just shown on the 12 range chart that the 62 area would primarily be my area of interest, back down to that demand zone off of the 12 range chart. Okay, now this is the 4 range chart. This is the rectangular zone, is the 12R supply zone. Okay, this ellipse or circular area here, what I'm showing here is a indication, or just kind of showing you an example representation of what an M structure will look like. Okay, it just looks something like this here. We see basically price rotating at a key area of supply right here. So look just like this right here. Okay, M structure formation. Most traders, you know, they just kind of classify that as a means of rejection. All it means is price is rotating at a key area where there's aggressive selling at, and we look for the rejection to go what? To go short, back down to some area, all right? Whether it's filling any imbalances back to the downside, or back down to a key area taking an area where price is taking out liquidity, okay, back to the downside, because price likes to move and just, you know, take out liquidity to the upside, fold, turn back around, and start to search or seek out areas of liquidity to the downside. We just don't know when. You know, we're trading based on high probability setups based upon what we see unfold in the market. Price takes out an area of liquidity, then it may tap into a supply zone, reject, boom, we're looking for it, take liquidity back down to the downside, and vice versa, because price is just trying to seek for areas of liquidity higher or lower. Okay, so once we see this area here where we get the M structure right here, all right, this is our 12R supply zone. What I'm looking for basically is you get the rejection, boom, you get the break below that area here, this V-shaped area right here, right below that area there, you can look to go short. So you'll be looking to go short around 69. Let's just say 69.5. Okay. Once you get that break below that V area right there, okay, on that M formation structure right there, then go short. We're aiming for the 62 area, okay, which is tapping us back down to that 12R demand zone, or back down to fill in those imbalances off the 12R chart. Okay, so what we see unfold once we're into the trade. Let's say like I said, let's say we get in at 69.5. Price pushes down, pulls back, and then breaks lower. What we see unfold here, I'm going to take off these little lines right here with these arrows. Okay, I'm going to redraw something for you here. Price pushes down, makes it a lower high, boom, breaks lower right here, right? Okay, so now price breaks lower. Once we enter a position below that V-shaped area that I showed you on that M structure at 69.5, what we're looking for to do now is price starts swinging to the downside, making little micro lower highs and lower lows. Swings to the downside, okay? So let's say I got in here at 69.5, all right? Okay, once I'm into that position of trade, once price swings down, makes a low, makes a lower high, okay, and then breaks below the low here, okay, and this could be an area of liquidity resting right here, you know, off this little swing to the downside, breaks below 68, okay, and closes with a candle or bar to the downside, then I'm going to be interested in moving my stop loss. So let's say my stop loss was originally right here, okay? Because if we're scaling down to the 4R, all right, and we're looking to get into a trade, we want to see some means of rotation and M structure. Once we're into a trade, like I said, at 69.5, my stop's primarily going to be above this area right here, okay? Or if you're placing your stop based on the supply area off the 12 range chart, your stop could be, let me show you. It could be, let's say this is the supply zone. All right. Now, if you get into the trade at the break of the candle, say for instance in the opposite direction, just depending if you're aggressive or not, most people probably will put their stop somewhere around here. So that's what, 72.25. Does that match up with what we have on the 4-range chart? Let's see. Yeah, 72.25 pretty primarily. Okay. So right there on the back end of where price rejected at. Okay. If you're aggressive. Now, some traders may put their stop right here. All right. Let's say this is the supply zone. You know, the median or midpoint of the supply zone area, which could rest right here around 72.5, you know, or maybe 73. Okay. Or some traders may put their stop loss right here at the back end of supply. Supply right here at 74.5. It just all depends, you know, on the actual trader. And how much they're willing to really risk on a trade. But I would primarily, you know, again, put my stop at the back end. So once wherever price taps into the supply zone, and if you're a very conservative style trader and you're scaling down, like I showed you, to get more of a precise entry, look for that rotation, look for that M structure, and, you know, put your stop loss on the back end of, you know, the rejection area. Once price breaks below that M structure area, then put your stop loss, as I just showed you, on the top end right here. This is the rotation area. This is the M structure formation. Price broke below 69.5. Put it right here on the back end right here of that area where the M structure lies at. Okay. Or, you know, if you want to, you know, if you're risking a little bit more and maybe you think price is going to maybe come up here and test this area 72.5, say for instance 72.25, and maybe actually test this full area of supply here, which a lot of times the market makers may try to do that by coming up here. Then those traders are trading off this supply area. Say for instance, they'll come up here and wick this area here out. Okay, they'll come all the way up here, wick this area here out, and then the market turns back around. So you could put it up here at 74.5, and maybe I won't put it tick to tick, but give yourself a few ticks above that, because some instances they will come up and test that area. So it's just all to the particular trader and what they're willing to actually risk. But most times, once you get the rejection, like I said, using pair charts, we scale down to the 4-range. We see the actual rotation, the rejection happen there. That tells you that there is complete interest in the market moving lower. So, you know, just put it on the back end of, if you can put your stop loss on the back end above that M structure off the lower time frame chart on which you enter your trade from, and you should be good to go. But again, we're talking about what to do once we're into the actual trade. Let's go back to our 4-range chart. We're into the trade here at 69.5, right? We got that low, that lower high, boom, price pushes lower. So on each swing, as the market was moving lower, let's say it made a low here, lower high, came down, a low here, a new high, a lower high, and then a new low. Each time that price makes, I'm going to show you. Give me a second. Here we go. So if our original stop loss is right here, okay, once we got that information, and then price came down and broke below that V shape or V point of the M structure, go short, right? Once we're into a short and we get the first lower and lower high formation here and a swing to the downside, then move your stop loss to here, okay? All right, because now you've got the break below here, okay? So because we got, like I said, the first swing in which price breaks below that V point structure off the M structure, and you've gotten to a trade, okay, execute a trade, and it makes its first low and lower high and then push the downside, then bring your stop loss to at the back end of the lower high. All right, so that's pretty much going to be your break-even point in a sense. Price pulls back, at least, you know, you're protecting your stop, protecting your trade. So let's say it pushes here and you still got your stop loss resting right here and you got it at 69.5, and then price comes back up here to 72.5. Well, you risked 3 points on that trade, right? And price stops you out and you lost some money. Didn't, you know, still, that's the part about trading, guys. You have to understand the risk of what you what you're doing when you're actually trading. I mean, that's the business, the game, what we play when we trade is being able to practice proper risk management, trade management. So what I'm trying to let you know here is that each time price pushes lower and makes a new swing to the downside. So let's get rid of this line right here. Okay. Hope I'm not confusing anyone, but So let's say it made this swing to the downside, broke below. Then it pulled back and made a new lower high and broke below again, right? We're going to take our stop that we moved right here from up here, and we're going to move it down here now. Basically, what we're doing is we're locking in our profit, right? Okay, so we were here, all right, at 70.5. Now we move down here to 69.5. Okay, so it's only a couple ticks, 4 or 5 ticks in the profit. But again, we're trading off the 4 range chart and we're aiming for that 62 area. Then price comes down and it does that again. Okay. All right. So let's just say it's made this push to the downside here and pull us back. So let's say this was a lower high here. Then price pushed lower as it did right here. And then it pulls back right here. All right. So now we're in here at about 4 or 5 ticks profit. 69.5, say for instance 69.25, and then price comes down here, pushes lower to now 67, let's say 67.25. Now we locked in 2 more points of profit. So I'm just trying to get you to understand each time price makes a swing, one swing to the trade, and we're scaled down to our lower time frame chart in which we enter the trade from, and it's making lower highs and lower lows off the lower time frame. Again, the aim is for 62 in a 62 area, right? 62.5, I believe it was. Okay, yeah, 62. We move now. We position our stop loss to 67.25 here, right? All right. Then it swings below. What does it do? It comes all the way down, taps into what? Our area of target. Okay. So if we got into the trade here at 69.5, and it took us all the way to 62. Well, what that does is it starts as we're moving our stop loss lower, according to price making lower lows and lower highs as it's swinging lower, aiming for that area of the filling those gaps or the imbalances that I showed you off the 12 range chart towards this low right here, or towards the area of demand, because this down here is demand now off the 12 range chart. We're able to start locking in profit as the market moves lower off each swing, lower high, lower low to the downside, aiming for that area of target. Okay. Originally we had it right here. This is going to be pretty much our risk area. Okay. Once we got to the trade at 69.5 off the 4 range, lower high, lower low, move your stop loss here. Okay. Lower high, lower low. If it did that swing made that swing right there, then bring it down to 69.25. Boom, breaks lower. Okay. Makes a new low, pulls back. All right. The moment it breaks, say below this area right here, move your stop right here. So each time that the market makes a lower low and lower high and breaks below the previous low here, okay, the first one will be here 68, all right, move the stop right here. Comes down, pulls back, breaks lower, breaks below this low here at 67.5, move it right here. Okay, so I'm going to show you, just for example, we got it in trade right here, all right, the market swings down, pulls back, the moment it breaks below 68, okay, move it here. Okay, lower high, breaks lower, below 68, pulls back, makes a lower high, breaks below here at 67.5, move it here. Okay, then the moment it breaks below 67.5 again to the downside, then we're leaving the stop loss right there. Okay, pushes lower, pulls back here to 67, breaks below here at 63. The moment it does that right here, then we move our stop loss right here at 67. Okay, so we're just moving our stop loss to lock in our profit as we are aiming for that area of target or TP. Okay, a profit target. Okay, so hopefully you guys understand what I'm talking about. As once you've marked off that supply and demand zone, again, I'm just giving this a rundown. Then mark it off. All right. Then when price retraces back to it and it taps in, we get the rejection, whether it's an M formation or W formation. W formations would be where you're taking a trade off of a demand zone. So if this was our demand zone off that 12 range chart and we get a W formation structure or a breaker structure, off of the lower time frame chart, pull back, go long, then as price is, breaking in an instance, if we had at a demand zone, making higher highs and higher lows, each time it breaks, it breaks the previous high, say for instance, like right here, breaks higher, pulls back, boom, breaks higher here, takes out this previous high here. I'm moving my stop loss right here. Okay. And every time that it does that, I'm moving my stop loss at the back end of the area from which it made a broke the prior high at. So hopefully that makes sense. But I'm talking about supply. So each time price makes a lower, makes a new low to the downside, I'm moving my stop loss at the back end of that swing. So that's what you want to do to really maximize the trade and allow yourself to, be in the profit. Or if, for instance, price came back right here, let's say we got in here at 69.5. All right, got in there right there, right? And we had our stop loss originally to say, oops, right here. Okay, all right, that's the original point. We entered right here at 69.5. Price broke lower, pulls back. Our stop loss is still here, okay, until it breaks below 68. Once it breaks below 68, then I put my stop loss right here at 70, right? Let's say at this point right here, let's do away with this line right here. Let's say price pulls back, and then it hits my TP right there. How much would I have lost? 2 ticks, okay? I would take a 2-tick loss. So this is a way to really, as price is unfolding at the supply zone with the rejection, and we are moving our stop loss according to price move as it moves to the downside, and we're moving it to the new area, or the new, I should say, lower high as price is making the swings to the downside, aiming for our profit target. We are able to lock in either profit or basically minimize our risk at hand as price is moving towards the profit target. So like I said, if price push lower here and pull back to this area here, now where we have our stop loss at, all we risk pretty much or loss is two ticks in profit. I mean, excuse me, 2 ticks in loss in a sense. Hope you guys understand what I'm trying to say there. 2 ticks right there, because our original entry would have been 69.5. Price pulls back right here at say 70. Let's see where we're at. 70.25, or just say 70. 2 or 3 ticks right there is all you would have lost. Okay, so basically I'm gonna stop off at getting stopped out at break even. Minus 2 or 3 ticks. Okay, I mean that's easy to make up in the next trade, correct? So I just wanted to share that with you. It's a simple technique or strategy of versus just leaving your stop loss from the point of entry. Scale behind it each time price is moving towards your TP, your profit target. In this instance here again, I know I'm reiterating what I'm saying because some people have to hear this. As it's making lower lows and lower highs, as it makes a new lower high after breaking through the previous low, broke below the previous low here, made a lower high here, broke below the previous low. It's the moment it does that, move your stop loss here. And each time it does that, move your stop loss so that you can lock in profit. All right, that's all I have today to share with you guys. I know I kind of reiterated and beat that to death, but I kind of wanted to show you a means or a technique of what you can use and practice in your own trading, okay? I appreciate everyone who tunes in and watch the videos on the daily, especially everyone who's part of the Discord community. And if you're not a Discord member, I highly recommend that you do so and come over and join us by simply scrolling down to the description portion of this video. Click on the Discord link and invite yourself in, and you can join us each day, Monday through Friday, when the session is primarily open, as we come together and share our trade entries and discuss those entries. So you can see screenshots of traders that are trading throughout the session. All right. Lots of people have found it very beneficial and have learned through means of watching other people, or share their entries, because they're able to go back and actually maybe particularly ask that trader, hey, what was it that you actually saw or you took interest in taking that trade, or the reason why. Traders explain, okay? So, and I post screenshots of my actual trades that I take. Lots of times, or sometimes I would say that as I'm doing my live recorded sessions, I will post my entries on there as I'm making videos throughout the day to post here on the YouTube channel. But I take screenshots of my entries as well. And there are tons of traders on there that understand the strategy that I use, trading supply and demand on the daily, and are able to benefit and use it in their own trading, okay? But you don't have to follow or, trade the strategy I use. Maybe you want to kind of maybe pick up on some things that, maybe that you're not privy of or didn't understand, and maybe you incorporate into your own trading. I'm not sure. But it doesn't really matter. We are here as a team to kind of help one another. I always talk about each one teach one, that type thing, because it's very important for us to be able to share information and pass it forward. All right. But please do me a favor, if you're a first-time viewer here on the channel, Please take the time, if you're not a subscriber, to go ahead and sub to the channel by clicking on the sub button down below. Make sure to click on the bell to turn your post notifications on. And the last and foremost thing, or most important thing to do, please drop a like on the video by clicking on the thumbs up button. I appreciate everyone who's tuned in and watches the videos on the daily, and especially everyone who is a loyal supporter of the channel. Take care, and I'll see everyone into the next week, because I look to do some trading next week, and hopefully it is a very profitable week for each and every one of you just as well. So look forward to seeing everyone next week, especially on the Discord. Take care.